This is the Building Wealth Podcast with your host, Stephen P. Sitkowski.
Well, welcome everybody. Stephen Sitkowski here. Welcome to my Building Wealth podcast. Thanks for taking a little time to find out what I got to say this week. There is, as usual, a whole bunch going on. I can tell you that. So we'll kind of dive into all of it, see if we can extract a few nuggets that you might find to be actionable in your financial life. And that's my whole goal behind sharing this. Those of you who may not know me, I've been working with people and their money now for some 45 years. And it's been an interesting journey. I've had an opportunity to train, I don't know, the best estimate I can give you somewhere between 1.5 million and 2 million people during that period of time. Absolutely, positively love teaching. I love taking whatever it is that I've found, if it's a great movie, a good book, or a financial strategy. And if it moves me, it's just fun telling other people about it. You know, one of the most common questions I get, how long are you going to continue to do this? How long are you going to continue to put on classes and share with folks? And the answer is, I don't see an end in sight. As long as I'm physically and mentally capable, of course, the latter, some would debate, but I will continue to do this. It gives me purpose, it gives me joy, and to watch people whose lives have been transformed, you know, partially or fully because of something that I was able to teach them, and they put it into practice and got the predicted result. I think it is just a fantastic thing. I want you to know that everything that we do here is for educational purposes only, should not be considered as investment advice. So even though I may comment on particular stocks or different things that I see that appear opportunistic, I'm not telling you to run out and buy or sell something. I don't know anything about your personal circumstances, so I am somewhat limited by that. So what's moving the markets as of today? Well, Iran's latest offer was considered totally unacceptable, quote unquote, by the president. He then went on to say that this ceasefire is on life support. Iran was reported to have said, we're not going to be bullied by the United States. Let me ask you, does that sound like there is a near term resolution? Yeah, not to me either. There should be. It's in the interest of both countries to come to some deal. We're both spending and or losing a ton of money. More importantly, we've lost lives on both sides. You'd think somebody could broker a deal. So far, it hasn't happened. In spite of this, the S&P has hit another record high. Let me just check very quickly and see where the S&P is. It'll take a moment. My internet up here is not fantastic, but that's all right. It'll pop up in a minute. Oh, there we go. Yeah, and the headline on CNBC, S&P rises to fresh record, sits at 74.04. So we're just barely hanging on. There's about 30 minutes left before the market closes as I'm recording this. So we'll see. You know, do we hold that or not? Point is, things are pretty darn good. Micron Technology, which I told all of you about, and NVIDIA, both are stocks that I own. I own more of NVIDIA than Micron. What got me fired up about Micron was their latest earnings, which was one of the best earnings announcements in history. I mean, literally. And the stock fell 20%. So I started telling anybody who would listen, there's a buying opportunity. If you feel like you missed it, here's your chance to get in on it. And those who did have certainly profited from that. And chip makers generally, and we'll look at a heat map, are generally trading up on the day. But that's good news for those of us who have participated. 10-year Treasury is a little higher. It's at about 4.4%. I'm hoping we can cap that at 4.5. Above 4.5, there's going to be a little agitation from the market, which is probably looking for a reason to pull back a little bit after all of these massive gains. That would be the thing that could perhaps do it. Let's not test it. But why are interest rates up? Because oil is up. So an hour ago it was at 98. Let me give you a current price on West Texas Intermediate. Yeah, it's still right there at $98 a barrel. So as oil goes up, that is considered inflationary. The way that the market deals with inflationary numbers is by moving interest rates higher, right? So that it preserves the value of the investment in treasuries. So just keep an eye on it. When oil prices go up, generally interest rates go up and vice versa. It's not a perfect correlation, but it's pretty damn close. Market breadth. So this is where we go below the surface to see the depth of whatever the trend happens to be. So we have the New York Stock Exchange. We have the NASDAQ. NASDAQ, of course, is tech heavy. And for last week on the NYSE, 1,554 stocks move higher, 1,251 were lower. What is more important to me are the number of new highs versus new lows. And it was pretty impressive. 370 new highs, 128 new lows. On the NASDAQ, 2933 were higher, 2157 were lower, 854 stocks hit new 52-week highs, 357 hit new 52-week lows. So very solid. I mean, there's no question that we are in a bullish trend, and market breadth definitely supports that along with the charts. And the winners for last week, Akamai up 26.5%, SanDisk, you've heard me report on this for about a month, has been absolutely ripping, up 16%. Micron Technology up 15.5%. Intel, which I own, up 14%. There's Moderna down there. I guess we've got a new plague, a new virus. So, that's good for business if you're in the vaccination game. I still don't know what I think about vaccines. I hear the arguments on both sides. You know what the problem is? I don't know who to believe. And isn't that a sad state of affairs? You don't know whether to believe your own medical community, your own government. It's always, well, who's got an axe to grind? Who's going to make the most money? If people are taking these vaccines. Isn't it sad that that's where we are today? This is last week's heat map. So you can kind of see where the big winners were. We talked about some of these. There's AMD and Micron Technology. Broadcom had a nice week. Intel has been ripping. Over in there we go, semiconductor space, those stocks are doing well. What didn't do well? Healthcare. Healthcare has been lagging all year. Financials. Financials have been lagging all year. And I think both are due to this whole AI disruption conversation that AI is going to replace a lot of what's being done by financial institutions. Is probably true. And what's being done in healthcare for diagnoses and interpretation and drug creation. So those stocks have been languishing. Earnings analysis. So this is fascinating. So you've got your 11 sectors right down here. Make a little check mark, right? So you just kind of follow along to the left. And the green bar represents earnings beats. And the big winner was technology. Now, ironically, after my last statement, healthcare had a number of earnings beats, but the market doesn't care because it's extrapolating what's going to happen to some of these healthcare companies when AI is able to step in and do all or part of their job. So, as a result of these earnings beats in tech, we have seen that sector move ahead very aggressively in the last month or so. A case for value. This is the most encouraging thing I think that I'm going to share with you today. So the S&P 500 is up 8%. So now this happens every time. What are the rumblings? Are stock prices too expensive? Is the market ahead of its skis? Well, what should be driving stock prices? Earnings growth, right? The value, if earnings go up, the value of the company goes up, hence price of their stock goes up. So that's kind of the logic. Well, what have earnings done? They're up 13%. So the market's not gone up as much as the earnings. And as a consequence, the PE ratio on the S&P is down 4%. Stocks are cheaper, technically, than before they have made this wonderful move to the upside. Logic says there must be room to move higher. And that's where we're at. I forecasted double-digit returns this year. A lot of people thought I was nuts. Well, that's probably a separate conversation. But it was all based on the fact, now I didn't know we were going to have a war, but it was based on what I saw the analysts were forecasting for earnings. They were saying earnings are going to go up 12%. Now they're saying they could go up much higher than that. Now, the war definitely put a crimp in my prediction as stocks pulled back. And I had people going, hey, now what do you think about your prediction? I said, I'm going to hang in there with it. It's not looking as good, but now we need to do is go up another 1.5%. And we're there. Comparing the numbers, forward price to earnings with different indices. So the NASDAQ 100 has the highest PE at 26, and it should. Why can it support a higher PE? Because it's got the highest earnings growth rate. So if you take the PE ratio divided by the earnings growth rate, you end up with what is called the PEG ratio, PEG. And the PEG ratio, I did this in one of my lessons with you, is the PE ratio divided by the earnings growth rate. In this market, anything less than about 2 is pretty good value. The Russell 2000, which has screamed higher this year, has a PE ratio of 25, but I think their earnings are probably going to grow and expand at a greater rate than even the NASDAQ 100. So that would justify those prices. S&P 500 right now is at 21 times earnings, a little elevated, no doubt about it. But is 21 too high? Not with the earnings growth rate. Equal weight S&P, that's where you give equal value to each of the 500 companies. The, the PE ratio is only 16, which is very reasonable. And the S&P mid cap is at 16 as well. So are we out ahead of our skis too much? No. We will get a pullback, but that'll be due more to psychology than valuation. Now we got seasonality to start dealing with. So what does that mean? It means that generally from January to now, markets go higher. And then starting in May, markets tend to move lower for a period of time. Right? Here's October right there. Yeah, October makes even the most seasoned investor get into the fetal position. You never know what's going to happen in October. So, are we going to have a sell off? I don't know. If we don't get the war resolved, and the fact that the market's already jumped, and now we have seasonality working against us, I could see a 5 to 10% pullback. If we get some kind of permanent peace in the Middle East, well, permanent as it can be in the Middle East, this market will move higher 5 to 10%. So we're in a news-driven market. There's no question about that. Now, this is interesting. AUM stands for assets under management. So what all the brokerage firms and the money managers attempt to do is to gather up all the assets because then they can charge some percentage of assets under management. So you would think that kind of their big pitch is, hey, when you put your money with us, we're going to be moving it strategically around to match market conditions. That's not what they're doing. 59% are passive. You're buying into a static portfolio. And I think a lot of that has to do with the 13,000 ETFs that are out there. Those are passively managed. So I'm not in favor personally of passive management. I think that you want to continually be evaluating, which of the 11 sectors is doing well, what matches the economy and the market sentiment. And, that's how you beat market averages. I'm finishing up a book right now, by the way, um, where the guy swears up and down that you can't beat market averages. And if that's true, then why have there been so many money managers who have for years and years and years? In fact, I was just looking at the track record of Peter Lynch, who used to run the Fidelity Magellan plan, and I don't know how many years, a few decades. I think his average rate of return was like 23% a year. Well, the market goes up on average 10% a year. So don't tell me it can't be done. It can. Takes more time, energy, effort, and expertise for sure. But shouldn't that be your goal? I mean, if you're going to be in the market and take a market risk, shouldn't your goal be to outproduce market averages? That's my goal. We got quite a bit of dry powder right now, money on the sidelines in money market funds. $7.7 trillion dollars. About 3 trillion of that are retail investors like you and I. 4.7 trillion, the institutions. So what happens when people get tired of these low yields they're getting from their money market accounts. I think some of that is going to end up migrating into equities, which would be really good for the equity market. How much? That remains to be seen, but that's a whole lot of liquidity. Market sentiment. The thing that I'm always interested in is kind of the direction. So last week when I came to you, I said that the results of the latest survey is that 38.1% of independent investors who responded believed over the next 6 months the market would go higher. That really hasn't changed. We're now at 38.3%. What has changed is the bearishness. So 2 weeks ago, 39.7% believed the market would go lower, slightly more bearishness than bullishness. Now, bearishness is down to 33%. So we definitely have a more bearish bent when it comes to the attitude of independent investors. And I think that's warranted, but I also think a certain amount of cautiousness is reasonable, given the fact that one negative announcement out of the Middle East could create some consternation for the market. Fear greed index is holding tight in the fear category. So this runs on a scale from 0 to a high of 100. And right now we're at 68. Yesterday we were at 66. That was on Friday, I should say. A week ago, 66. A month ago, 38. Look at how much has changed in just a month. We went from fear to greed. Now, what is the significance? Greed causes buying, fear causes selling. Selling causes prices to fall, buying causes prices to go higher. Kind of a big deal. It's why I look at this every week. The future of interest rates. So, coming into this year, we were expecting 2 rate cuts. That was kind of built into the value of the equity market. Stock market loves low interest rates. It eliminates competition from bonds, among other things. Plus, it stimulates the economy. It causes people to be more likely to borrow and to spend. Companies make more money. So the markets love low interest rates. Well, then the war in Iran breaks out. Oil prices go through the roof. All of that is inflationary. And as a consequence, the Fed's hands are tied, at least for now. They're not going to lower rates. And even if you come all the way out now to December of 2027, what are the chances of a rate cut? Well, not very good. You can kind of add up zero point 0.2 to 2.1. So that's 2.3. So that's 16.7% probability that we get a rate cut. 41.3% chance that we keep interest rates where they are. And there is a 42% chance that rates go higher. So forget about the rate cut. What we need to be focused on are the Fed's going to raise rates? That is generally a big negative for the market. But you know what? That's not near term. The next rate announcement will be in June. And right now, there is a 95.8% probability, no change. And we don't really start forecasting the potential for higher rates until December. In October of 2027, but that's so far away. This will be an entirely different picture. So I'm not concerned about that at all. Sector performance year to date, S&P 500 is up 8.46%, led by energy, of course, higher oil prices, up 26%. Look what's number two, technology is up almost 17% because of the stellar earnings season that we just came through. Technology was kind of down around where financials were not very long ago, and they have come storming back. Materials and industrials are up. That's AI data centers. They're talking about putting one in the state where I live, and the state is revolting. So, I think they're probably going to end up in space. No, nobody wants data centers. I guess it would create some jobs, but man, it sucks up water and energy, and they're fairly, you know, there's a price you pay for everything that you want, right? But anyway, those data centers are the reason why materials and industrials are up the way that they are. There are only two sectors that aren't trading higher, financials. I still think there's a lot of value there, gang. If you're looking for stocks to do covered call trades on, I think financials are a pretty good bet. I really think that with deregulation and a very robust forecasted IPOs um, season coming up, I think some of these big money center banks could do very well. Healthcare, I don't know about. That's kind of outside of my area of expertise. So this week's earnings, there isn't anything on here that I see really moving the market. I'll be interested in the numbers from Rigetti because of the AI connection. Same with D-Wave, same with Oklo. Other than that, I don't even know if there's anything. Well, we got Cisco, so that could be somewhat interesting. Anything else on here we should care about? No, not unless you're in them. So there's no real big market movers there. News of the week. We've got lots of news um, coming up. So let's take a look at what you're going to want to keep an eye on here. Then we'll take a look at the charts. So for today being Monday, that's the day that I'm recording. Um, Existing home sales down a little bit from the forecast, but up a little bit from last month, but that's inconsequential. On Tuesday, there's some important things. You have the NFIB, that's the Small Business Optimism Index. I mean, is it worth seeing how small business feels about the economy? I think so. They got their finger on the pulse, do they not? Then we've got inflation news coming out. So let me kind of break this out for you. You have the CPI that'll be announced. That's the Consumer Price Index, supposed to come in at 0.6% month over month. But the CPI year over year is only supposed to come in at 3.8%. I mean, it's still fairly elevated, but here's the key. You want to look at the core numbers. So the core excludes energy and food prices due to their volatility. So you have the core CPI supposed to be up 0.3%. And year over year, the core CPI is supposed to come in at 2.7%, a tenth of a percent higher than last month. But keep it under three. I think the markets can probably live with that. Then we have the producer price index, PPI. This is inflation at the wholesale level. And I'm sure you can all connect the dots. Inflation at the wholesale level is a precursor to what? Inflation at the retail level. So, um, we'll keep an eye on both, whatever that number is, along with the core PPI. That's supposed to come in month over month with an increase of 0.3%. On Thursday, like we do every Thursday, we will get the initial jobless claims number. So last week it came in at 200,000. They're forecasting this week at 205. Um, Retail sales will be announced. That's something I keep an eye on. At a very basic level, if consumers are spending money, then companies are making money, which means A, good for the stock market, and B, good for the overall economy. That's how you stay out of a recession, by having people out there spending money, which they are anticipated to do so. So I think those are the big announcements that you're going to want to keep track of. All right, let's look at the charts. So I'm going to, first of all, let me pull up a chart on the S&P 500. There we go. So the market's definitely come back down a little bit. I'm sitting here now with 9 minutes left before the market closes, and the S&P is still in positive territory. It's actually bumped up a little to 0.15%. So, I mean, you can see this chart. Here's the ceasefire down here. Since then, the market's gone up, even though the ceasefire, best I can tell, hasn't held. People are still shooting at each other, right? Launching missiles and all that stuff, and threats are being volleyed back and forth. But it's a beautiful chart. I made mention of the fact that we've gotten a long way away from our 50-day moving average. That, coupled with the fact that according to the RSI, the relative strength index, we are in overbought territory. So anytime we're above 70, market's considered overbought. Right now we're at 74.92. Now, one of the things I look for is a combination of overbought and the MACD turning red. So far, the MACD is green. That turns red, my level of concern goes up. And then I also look at on balance volume. On balance volume is a running total of volume. So it's added on an up day, it's subtracted on a down day, and its trajectory is slightly higher. So, but all of this comes back to the fact that we are very much in a news driven market. What the market will do, in large part, will be dependent on what happens, with this war effort. Let's look at an intraday chart. So each one of these little candles represents a minute. You can kind of see we started off really well, and then there's a little pullback. And then we came up here, we formed a double top. I've taught you about double tops. Those are bearish, right? Whenever you see what looks like an M, M stands for murder, and you saw the market fall, set up a base, also known as a support level, and it's tried to move a little higher from there. Nothing particularly dramatic about today's action, one way or another. The other thing I want to look at is the VIX, which is the volatility index on the S&P. The VIX is up today, 7%. It's not a huge move. The VIX moves a lot, but it's enough for you to go, okay. So the fear level is on the rise. And I'm sure, you know, a lot of that is due to the rhetoric coming out of the Middle East, for sure. So one would expect people to be a little nervous. So these are some statistics that I use from time to time, look at from time to time. And, getting back to what is it that drives and motivates me? It's the fact that we live in a country with unlimited possibilities, and yet such a huge percentage of the populace struggles. So take a look at some of these headings. No savings. Okay. What percentage, and we'll use the whole sample, right? They break it out based on generation. We're not going to do that. But what percentage of adults have no savings? 15.4%. And 40% live paycheck to paycheck with difficulty. There's another 22% that have less than $1,000. They're in a big difference between less than $1,000 and no dollars. There's another 18% with 1 to 5,000. So basically what you've got 37, 55% of adults are broke. And then another 15% has less than 15 grand. What percentage of adults have over $15,000? 29%. Not 1.5 million, not 150,000, 15 grand, less than 30%. It's not due to lack of opportunity. It's that people just don't know what to do to get ahead. Some of you are like, yeah, that's why I'm listening to your podcast. And this is as good a place as any to start. So, as you may or may not be aware, my trading partner and I have a service where we provide trade ideas for people that have some knowledge of options. Last week, I talked a little bit about options. I'd like to share with you a trade that we had recently closed. So, this is one on Ulta, the beauty company. So, basically, we put on a trade. It's called a call spread, where we bet that the price of Ulta on expiration would be greater than $510 a share. Just out of curiosity, let me see where that's trading right now. We've closed this trade. Um, like I said, the internet on this is kind of eh. It says no results were found for Ulta, big publicly traded company. Here, let me try it a different way. I'll show you the chart on Ulta, as a matter of fact. Oh, now it's coming up. That's all right. Too little, too late. There's the chart on Ulta Beauty. So it's at 511.85. So the reason we thought it'd stay above 510 is because you have this nice level of support down here. So the fact that on expiration, which is May 8th, that was my dearly departed dad's birthday, um, we were in that trade 10 days, made a profit of 22%. And that's not unusual for us. 22% in um, 10 days. Normally it takes 2 years to make 22%. So if you'd like to take a look at that service, feel free to go to tradeideasoftheweek.com. And if you do here, let me just show you. I'll do this all live for you. So if we go trade ideas of the week. So the upper right-hand portion, there's a little video that's about 8 minutes in length. I talk a little bit, my trading partner talks a little bit. But if you want to see, click here to see our track record. So that's the track record for this year. So far, on our closed out trades, we're at 100% that have been profitable. Average time in a trade about 10 days, and we've averaged about 17%. So that 22% in 10 days was not that much of an outlier. 2025 average return was around 13.5%. Average hold, let's call it a month. We were profitable on 96.95% of the trades. 2024, average return almost 16% in 21 days, 92.25% profitable. So, like I said, if you're interested, go to Trade Ideas of the Week, get all the details. Other than that, hey, thanks for hanging out with me again. I really enjoy doing these podcasts on what otherwise would be an off day for me, other than just managing my trades. Um, but I enjoyed so much that I took one of my off days and dedicated it to doing the analysis and the prep work so I could come and spend a little time with all of you good folks. So spread the word if you like what you see. If you don't talk to anybody. Just teasing you. I'll be back with you next week. Until then, be safe, be blessed. Bye for now.